Hello viewers. As a financial advisor, I often consider how to hedge portfolios. This is not a straightforward question. My first response is, what are we hedging against? In the most common scenario, the answer I get from clients boils down to systemic risk. When they own an index like the S&P 500, which will frequently be through the SPDR S&P 500 ETF Trust, NY circa SPY, they want to hedge against dramatic events outside their control, like wars or stagflation like we saw in 2022. There are a lot of strategies that could have helped prevent some of the losses investors saw that year. Often they come at the expense of some upside performance, such as the debit costs associated with buying protective puts. Normally, advisors that are asked to hedge the downside of an equities portfolio would do one of two things. 1. Use options like I mentioned above. 2. Add bonds to dilute the portfolio's volatility, i.e. 60-40, etc. Participating in bonds is helpful for reducing market volatility because bonds do not have a high pricing correlation to equities. This means that SPY and an aggregate bond ETF like BND should have no real correlation. Lo and behold, it ranges from 0.8R to 1R. Modeling the trade. I want to disclaim that this is not a strategy intended to beat the market. It will underperform the market, most likely. The purpose of this strategy is to protect and hedge the portfolio's downside while offering participation in the bond and equities markets using a popular ETF. This is a strategy that I have advised a DIY investor client on selecting strikes, etc. for this strategy. Credit for this strategy is not mine, but that client of mine who gave me permission to share here. He manages his own portfolio as a DIY investor and contracts with me for occasional advice, where I help select strikes and advise on timing. This strategy is also intended to be run alongside an equities portfolio to soften the downside and provide potential for additional upside in the future. The basics of it are this. 1. You buy $50,000 worth of bonds, fixed income products with low volatility. Use those bonds to sell a 1-year put on SPY at the 500 strike, collecting premium as cash 3. If SPY stays above 500 in 1 year's time, total return is the bond return plus $1,500 or 2.7%, math shown below. If SPY falls below 500 in 1 year's time, total return is bond return plus $1,500 or 2.7%. Difference between SPY's real price and £500/100. That last part might scare some people, but consider that 500 is 15% below the current price. In a $100,000 portfolio that is 50% SPY and 50% this strategy would be able to be 50-50 in the markets unless it crashes 15% plus, then they are able to switch into the markets and buy in. If the market doesn't crash, then the bonds earned an extra 2.7% interest, making them more worthwhile than traditional bond holdings. The Sol put 1 SPY 930.25 500p at 15, and I picked this at the time of writing, after market 10.124, and this may not be accurate at the time of publication due to market fluctuations. This strategy relies on having collateral to sell a put. Selling a put means that you are obliging yourself to buy 100 shares of the underlying stock at a select price on or before a select date. In this case, we are looking at the $500 strike of SPY on the Sept 30th, 2025 date. This strategy will go for 1 year and reset at the end of the year, able to be repeated. You may want to change the frequency of the rolls, explained in more depth later, dependent on your willingness to manage the portfolio. In backtesting, the best results were with monthly rolls. To sell that contract, we need the cash to be able to buy 100 shares of SPY for $490. We need $490 since £100 owes $49,000. We will receive $1,500 as a credit for selling the put. Don't spend it all in one place, reinvest, take as income, etc., but we are counting it in total return. I will discuss what bonds I would buy later, but let's focus on the option first. The buffer between the current price and our strike is 15%, meaning that SPY would have to have another 2022-like year to trigger the hedge to change and buy into the market via the sold put. Otherwise, the portfolio stays at a more stable 50-50 allocation with juiced-up bonds from the option premium. How much are we long SPY? The answer is surprisingly straightforward. The delta value gives us our directional correlation, and at a value of 19.7, 0.197, this means that we are long the equivalent to almost 20 shares of SPY at this time, and equivalent to 11,814 if purchased at market price. Note that this may change day to day as SPY's price changes. The calculation is straightforward. Current leverage equals delta option price. Current stock price. Our leverage from the option is $568.62, so 197.15, equals 7.5. This is also a measure of our capital efficiency. Bonds, bonds, bonds. I've written a ton on various funds that I like and recommend checking out my profile from this time last year when I went on a fixed income binge and produced some great work on short-term bonds, CLO investments, and whole bond portfolios. Much of that information is still relevant, since bonds move slowly and the asset class hasn't changed too much since then, aside from the recent rate cut. What bonds you hold are up to you, but I would recommend the following qualifications for choosing the best allocation. 1. Buy low-duration bonds like floating-rate CLOs or T-bills. 2. Buy investment-grade or high-credit-rated bonds. You do not want to add too much credit risk. 3. Consider municipal bonds in your state of residence for tax-free income. Conclusion. This strategy is one that has interested me as a market timing technique. Having $50K set aside to run this strategy may be hard for smaller DIY investors, but this can be scaled with other S&P 500 ETFs with lower prices than SPY. I caution investors that dealing with options implies great risk, and one needs to consider that substantial losses could occur if the market dropped more than 15% in a year. If it dropped 50%, you'd still be buying in at 500 despite the market being closer to 300. Make sure that your risk tolerance is such that you could handle that possibility. Those without enough risk tolerance to catch the falling knife and buy into the market during a downturn, that strong should avoid this strategy. This is a strategy I do not recommend to any conservative investor, but do recommend to aggressive investors looking to try a market timing technique that can hedge a portfolio and provide extra returns, or give an opportunity to buy into a beaten-down market. Please let me know if you are interested in more unorthodox option strategies articles. Thanks for reading.